I try to steer away from conventional indicators. I want to show you something a little bit different. The analysis that I do is based on whether the market and the candles move up or down. Obviously, price action is price action. It can be traded across multiple markets, although my preferred market is the E-mini S&P. The methods that I teach, along with the Atlas Line software, can be traded on any market as well. So if you are interested in checking out the DayTradeToWin blog, there's a lot of information on there, and you can check it out, daytradetowin.com blog. Also, there's a few freebies that I like to give away. You can sign up for our newsletter, and in the newsletter, it gives out trading videos, and it gives out educational resources. So you can download 3 free educational videos, and as well as the newsletter, just by putting your name and email address on the top of any DayTradeToWin page. And there's also a free software that I like to give away, and especially those of you who are interested in trading the news or knowing when news events are being released. For many years I've been looking at the Bloomberg Economic Report or even the Forex Factory calendar, and so I've created a indicator that plots right on NinjaTrader, and this news indicator tells us when there is a news event that has a red star or red text, because those are the market movers. And so you can download the news indicator here at the downloads page on the DayTradeToWin website. So if you haven't done so already, it's a great free indicator that allows you to know what news events are going to come out. You can change it for European news or for US based news. Some of these things that I'm going to show you I teach in the mentorship program today. So what I'd like to do is talk about price. I want to show you what's to be expected in 2013. So before we begin, what I'd like to do is go over a disclaimer. Obviously everyone here needs to be aware that trading is risky. Please do not trade with funds you can't afford to lose. So anyone who does trade, please make sure you understand that any type of Forex or futures or options trading or stock trading is risky. Now what I'd like to cover today, and usually I try to go in detail, is the price action trading, how to follow price, and why I do what I do instead of looking at MACDs or moving averages or anything like that. I also want to show you about this ABC pattern that I've been showing traders for many years now. Specific setups, entries to trade. I'm going to show you exactly where you enter, why you enter. I want to use proof with price. I also want to use the ABC pattern for different trading sessions. So this ABC pattern that I'm going to show you today does not have to be just on the US session. You can also do this on the London Open or the Asian Open. How we think of traders, we usually make the same mistakes. We usually place the same stops at certain places. It's normal, right? We all like to place stops at Fibonacci levels or at even numbers. I try to get away from that. I want to show you that those areas are where things usually reverse on you, or could potentially be placing a stop at the worst place. So all these things I want to cover today. All right, so everything you need is being played out on the chart. Okay. Now, as you can see, the chart I'm going to show you in a little bit has just candles. Right. Here's a copy of a chart, and I like to say that everything that is happening here on the chart is all we need. We don't need any complicated indicators to tell us what to do, what exactly waiting for. I want to be as simple as possible. The simpler, the better, actually. Okay. So when I look at price, I understand that market's going down. I understand that there's a strength trade here occurring. I want to have a very objective entry. I don't want to have an entry that is looks like or could be kind of deal. I want to know an exact price. And then I want to take it all and put some rules to it, making sure that my stops are correct, my entries are right, and all that good stuff. So really complicating things is how traders like to do it. I like to take a step back, and I don't like to complicate things. I want to make things simple. The one thing that you're going to see here on the chart, though, is this ATR, the average true range. I talk about it a lot. If you're new to trading, or if you have traded and you aren't using the ATR, let me explain to you a little bit about what the ATR is all about. The ATR, the average true range, is basically an indicator that's included with NinjaTrader. It's in alphabetical order. It's called ATR, average true range. It's right here. I'll just show you. And it's right here, ATR. Now I have the ATR set already here, but the ATR, the average true range, I use a setting of 4 or 5, usually 4 works better. And really what this is telling me is that the current market conditions are being shown to me on how the market is currently acting or reacting. All right. So what this means, and if you're not using this, I really want you to take a look at it and see if it's something that you can add to your chart and see if it does really help your trading. So what we have is price being displayed by these candles on a 5-minute chart, and then as soon as a candle closes, it calculates what the average true range of the last 4 bars is. The last 4 bars tell me if the market is slow, if the market is fast, what's really happening. Okay. So when I see the market very volatile, I need to be aware of it, because you can't trade the same way when the market's slow as compared to when the market's fast. So if you add the ATR to your chart, the average true range, you're going to see that right here and right now there is on average 2 points of an average true range. That means from right here, or from this closing price right here, the market will go up or go down on average 2 points. Okay, that's all it is. So if the market is going to go up 10 points, this will most likely tell you that's not true. Okay. If the market is very slow, you're going to see that this ATR is going to be 1 point, or half a point, or 1.5 points, or 3 ticks, whatever the case may be. And you know what to expect. You know that the market's going to go up or down by that exact number. Now, sometimes it goes a little bit beyond it, sometimes it misses it by a tick or two, but this is a great way to know what your expectations are. Now, I always look at the ATR to tell me what to expect. I want to take more profit when the market is faster, less profit when the market is slower. But I just can't assume that every trade is going to give me 3 points or 4 points, because that may or may never happen. So looking at this here, this is the ATR. It's included with NinjaTrader. I recommend everybody apply it. The defaulted setting is 14. I would change it to 4. Okay, last 4 bars. Mohammed says here, is that the Atlas line? Yes. The Atlas line is being plotted right here. And this is the entry, 1448.75. 2 consecutive closings below the Atlas line. That closing price will always be the same price, and then we just have to manage the trade. If the market goes down, you have a set profit based on the ATR, which happens to be, let's take a look here, at 2.25 points. So 1448.75 is the entry. 2.25 points below that would be 1447.75, 1446.75, 1446.50. That is my profit target right there. Okay. I also have what I call a time-based stop, a prove-it stop, all to protect me in case the market never gets to my profit target. So we do have to have stops in place. Usually a time-based stop is a time-based stop is usually a stop that is based off of how much time you're allowing this trade to work. I never like to hold on to a trade for hours on end. Personally, if you hold on to a trade for 2-3 hours, I use a time-based stop to tell me what exactly I should be looking at and for how long. Usually no more than 20 to 25 minutes I like to be in the trade. If I never make that profit target, then I'm out of the trade. That's how I interpret what's happening. Okay. Anyone have any questions? Okay. So let me put this away here just for a second. This is the Atlas line. This is the entry to go short, 1448.75. Put this away here. So everything you ever need is being played out as you see it on the chart. Okay. Having a blueprint to execute the trades is essential. Don't trade without one. When I say a blueprint, I say an exact entry, an exact stop, multiple ways to configure your stop, like I have a time-based, a prove-it stop, and a catastrophic stop. There's also pivotal stops that I use under certain conditions. So always know exactly what you're doing before you enter into a trade. Trading price action is really how successful traders do it. Nothing else matters. And the reason why I say that is because I've never heard or seen a successful trader either on the floor or off the floor ask me where that 50-day moving average is or where's the stochastic. It's not really something that any professional trader looks at. They're really concentrating only on the price and what's happening. Okay. Now, ask yourself, what is the price telling you? Follow the chart and follow what the price is telling you. That's always the best way. Some questions here. Do you always use a time-based chart? My personal, Greg, is a 5-minute chart. Some traders like to use the methods that I teach with the Atlas line on range charts or tick charts. My preference is a 5-minute chart. And the reason why I like to use a 5-minute chart is because I'm looking at multiple things. The open works on a 5-minute chart. The power price action is on a 5-minute chart. So the methods that I like to look at on a constant basis are all being held on one chart. But you can use tick charts or range charts if you wish on the Atlas line. Okay. Can you re-explain, AK says here, can you re-explain the ATR again by taking a future example? Sure. Let me bring back that chart right here. Okay. So take, for example, this strength trade over here. Okay. So you have here the 3 S's. I'm not sure if you could see that. There's an S here, S here, S here. So let's say we don't know the future, right? Let's say that the market looks like this. Okay. This is for AK to answer his question. And we don't know the future, and the market is as it is. This bar closes, the ATR plots, and it's at 2 points. This tells me that the current conditions based on the last 1, 2, 3, 4, actually it would include this one if this one closed, the last 4 completed candles, whether it be a 5-minute, 3-minute, 1-minute, 10-minute, whatever you're looking at, the ATR, AK, tells me that I can expect the market to move up or down exactly 2 points or 8 ticks. Now, if the market is more volatile, these candles here prior to it, let's say that they are larger range, then this is going to be a larger value. It's a 1-to-1 ratio. So I can expect from this point the market to move up 2 points or down 2 points. Now, you asked me to give you an example into the future, right? So let's take a look at where we are here right now. Right now, the last 4 bars that have plotted has given me an ATR of 7 ticks, 1.78. So I can expect from this closing or from this open, it's really the same thing, that the market will move up 7 ticks or down 7 ticks. I can't expect the market to do much more than that. So the reason is if I have a profit target of, let's say, 12 ticks, I know that the chances of it reaching 12 ticks are slim because the current conditions already tell me it's 7 ticks or 1 3/4 of a point. So when I understand what to expect, the ATR tells me that this candle, the high to low of this candle, will be 7 ticks or within the next bar to 7 ticks, AK. And so if your profit target is 12 ticks, you know that you may not get that. Or if the market is very slow, let's say it's 4 ticks or 3 ticks and you're holding out for 12 ticks, it's never going to happen. And also, if the market is more volatile, you want to be able to take that. You don't want to take less than that. Okay. All right. Okay. Now, Owen says here, before Owen, I have Mohammed. When I place an order, if I want to use Atlas line in this example, you would place the order at the close of the candle. Okay, so this, as soon as this 1448.75 occurs, you're going to place an order at 1448.75. The strength trade here, as soon as this candle closes, this is a strength trade to go short. As soon as this candle closes, you're going to go short. Usually, I don't like to use market orders. 1448 is the close of this. Let's see if I can remove it here. Yeah. 1448 is the close of this candle. That's my short entry, 1448. Mohammed. So to answer your question, when do you enter? As soon as this candle closes, this is the entry. It's the closing price. You're short. As soon as this candle closes, you're short. Owen says here, what is the Atlas line? The Atlas line is this dotted line that you see here. It could be dotted or solid. It's right here, right? And this line right here is plotting once the market starts. And what happens is you're going to enter long or short based on that market, wherever it is in relevance to in relationship to the Atlas line. So really, I'm not thinking about entering long or short on the because of the Atlas line. I'm usually following price. So if price has to close above or below and continue above or below the Atlas line in order for these long and short trades to occur. Therefore, in order for me to go short, these candles, whether it be a 5-minute or 1 minute, whatever time frame you decide to trade, they have to be below the Atlas line. The same thing for above the Atlas line. I want to go long if price is above the Atlas line. But I have to do it right. I have to put rules to it. It's not only because it's above or below. So the rule for entry is 2 consecutive closes above or below the Atlas line will give me a trade. And that's why you see here this 1448.75 is that closing price. Okay. That was for Owen. Clint B says, I noticed plus 16K, 10 contracts in latest trades on your site. Are those Atlas only trades? They are Atlas only trades, Clint. Or do they also include strength and pullback? Well, Atlas line trades do include strength and pullback trades, and they're only trades that occur up to noon Eastern Standard. So it's only the first 2.5 hours of the day. Even though there are additional trades that happen into the afternoon, Clint, I include the strength and pullback trades as well as the original, which starts it off here, the double bar short, 1448.75. So when I calculate the results, this is an entry here, this is an entry here. Okay. All right, Clint. AK says here, thank you so much. Can you please touch on the Atlas line? Okay. Okay. AK, I already touched on the Atlas line. Mark B says here, do you use the ATR for a stop area? I don't usually use the ATR for a stop. I use it for a profit target. What I use mark for the ATR, the average true range, as a stop is I usually double the ATR for my stop. And I use that as a catastrophic stop, because if I have a stop that's exactly 1 times the ATR, it's not going to work. I already know that the market's going to go up or down by this amount, this exact value. So 1 3/4 of a point up or down is what I can expect at this moment. Now it's at 1.5 because I always round down, so I can expect 1.5 upward. So if I have 1 times the ATR, it's going to stop me out prematurely. So I usually use double the ATR for a catastrophic stop. Okay. That was for Mark. Alex says here, what is your risk reward when placing a trade? The risk and reward is based off, to start off, the ATR. So if the ATR set tells me 7 ticks, I want to have 7 tick profit target, and I want to have a catastrophic stop to start me off, at double the ATR. As this trade moves along and I still have not reached my profit target and it hasn't reached my catastrophic stop, that's when the other stops come in play. Time-based stop and a prove-it stop. So to answer your question, the reward will always be 1 times the ATR for the double bar long, double bar short trades, and the stop is going to be threefold. It's either going to be a catastrophic stop, it's going to be a time-based stop, and it's going to be a prove-it stop. Usually the catastrophic stop is not tagged. Instead, if it never reaches your profit target, it's either a very close to break-even trade, a small win, or small loss. And that's based off of the time-based stop. Okay. AK, how do I get the Atlas line? The Atlas line is located on DayTradeToWin. Here is the Atlas line page. And you can take a look at some videos, and you can purchase the Atlas line right there directly on the DayTradeToWin page. AK, all right. Mohammed says here, how do you specify the 7 tick stop? Mohammed, the stop is based off the ATR, it's based off the time-based stop, and it's based off a prove-it stop. So there's a combination of 3 stops that are used whenever I enter into a trade. Okay. Okay, you got it, Alex. You're welcome. Rick says here, any special offers today? There is a few special offers. Currently, because of the new year, I have a special. You can use this coupon code, NinjaTrader 2013, for 15% off. And that's good for the next week or so. Okay, so just a New Year's promotion, NinjaTrader 2013. Okay, for 15% off. Okay, Rick. Giscard says here, what are the 3 stops for the Atlas line? I know the time-based stop and the catastrophic stop, I believe. There's the third you mentioned. The prove-it stop is based off some type of proof. Giscard. Okay, so along with some time element where we say to ourselves, there's enough time that I've waited for my profit target to be reached and I haven't yet achieved it. You know, I have to get out of the trade. So a time-based stop is usually 4 or 5 candles after you enter. A catastrophic stop is just in case some type of catastrophe happens. You have to have a stop there to protect you. You can't let one trade destroy your account. The prove-it stop is based on some type of proof. All right. So let's say that the proof is that the market is, you enter short. Let's say right over here. You enter short right over here, 1448.75. And the market right away goes against you. It goes against you, it goes up and up and up, and it closes on the opposite side of the Atlas line. At that point, that's proof enough for me to say I'm out of the trade. So a prove-it stop is based off price closing on the other side of the Atlas line. So this is a prove-it stop, a close on the opposite side. proving to me that I shouldn't be short any longer. Maybe I should be looking to go long instead. Time-based stop and catastrophic stop. Okay. Discard. Okay. All right, very good. The ABC pattern, sure thing, Alex. So anyone have any other questions on the Atlas line, on the stops that I use, how I use price action instead to look at how to trade? Because remember, the Atlas line is a tool that tells me when to go long or short, but I'm actually using the price itself to pinpoint the entry with this exact entry, to pinpoint these strength trades that you see right here is based off of a price action. We're below the Atlas line, so this is a strength trade to go short. I'm also using the stops based off of price and time to get me out of the trade if it never happens. It doesn't go in my favor. Okay. Okay, so let's talk about the ABC pattern and the January effect here. So everything you need, like I said, is always on the chart to tell me how I should manage and what to do, what my entries are, using the ATR to tell me what the range of the bars are. Everything, it comes together. And I actually teach this with mentorship. I go into much more detail on price manipulation and how to trade these methods. And the Atlas line also includes about an hour and a half of training, because you have to understand how all this works when trading the Atlas line. The next mentorship program is and starts on the 15th, January 15th. So January 15th, I have another mentorship class beginning. Those of you who are interested, feel free to email me or can sign up right on the website. All right, so the ABC pattern. What is this ABC pattern all about? Okay. The ABC pattern is something that I look at constantly to tell me what kind of day or what is happening in the current day. Okay. So the A part of the day is and starts at 9:30, which is when the E-mini market opens for me. If you're in a different time zone, let's say you're in Central or Mountain or California time, then you're going to be able to change that time to 6:30 or 7:30. But it's usually when the U.S. market opens, whatever your time zone happens to be. For me, it's Florida Eastern Standard Time, so 9:30, and the next 2.5 hours to 12 o'clock. So that's the A part of the day. The B part of the day is from 12 o'clock to 14:30. So the next 2.5 hours. The C part of the day is when the market ends here at B to the close. So I'm isolating, I'll show you a chart on this in just a moment. I'm isolating the three parts of the day as the A part of the day, the B part of the day, and the C part of the day. Now there's a reason why I'm doing this. Markets that trend have certain characteristics. Markets that whipsaw all day back and forth also have a certain characteristic. So if you're looking at what is normal, price trades within the range of A about 85% of the time. So if I know that markets usually get stuck, right, trending days, day that trends up or trends down, only happens about 15 or 20% out of the year, trading year, I can definitely say to you that I'm looking for it either to trend or to whipsaw as it does about 80-85% of the time. Now, what is the difference? Well, I can identify a trend early in the day to tell me that the market's going to head higher or head lower. So instead of guessing, I want to guess that the market is going to whipsaw, or I'm going to guess whether the market's going to trend, one of those all up days or all down days, or it never ends. Use this to tell you if that in fact is happening or is going to happen. So let me show you a few charts on how this works, okay? So here we have an exact year from today, January 3rd, 2012. That was the first trading day of 2012. And I'm using this example because it's exactly 1 year from today. Well, almost 1 year and one day. Right? The first trading day of the year is today. The first trading year of 2012 was January 3rd. And so in analyzing the day, I didn't know what was going to happen. We're looking at this in history. But if you outlined the ABC pattern as the day was unfolding, you could pretty much know what to do, where it's going to go, and just prepare yourself. More importantly, prepare yourself on what to expect. So we have here the A part of the day, which happens to be from the US Open, the first 2.5 hours. So for me, it's 9:30 to 12 o'clock. If you're in California, it'd be 6:30 to 8 o'clock, I believe, or 9 o'clock. So the first 2.5 hours. Okay. Now, what I'm looking for, oops, go back here. What I'm looking for is for price to trade outside of the A part of the day, to show me that as soon as noon comes around, it's not staying confined here within the A. Price is not whipsawing back and forth. It's breaking outside of it. So here is my opportunity to go short when usually I like to see 2 consecutive candles that close outside of the A part of the day. Now I can show you very recently, just bring up my chart here. Here's my chart right here. And we can go to, let's take a look here. 12:31, I believe, was the last day we had. So here is 9:30, 12 o'clock. And here is the A part of the day, from here to here. Highest high and lowest low from the start of the US market to the first 2.5 hours. Now, I don't know what's going to happen, right? Like everyone else, I'm not a fortune teller. I need to follow price to tell me if the market's going up or if the market's going down. I have no idea. So 2 consecutive closings, either above or below, once we're in the B part of the day, tells me that market's going higher, wants to go higher. It's not getting stuck between this, like this. And this is what 85% of the time it gets stuck here. So we have 2 consecutive closings above the A part of the day. I call this the A part of the day, and I call this the B part of the day. And I know that the market is going higher. We're in a trending environment, trending higher, and this is what happens. Market went up. Typically, 85% of 85% of the time, market gets stuck here. But if we have proof, remember, we're using price as proof that the market is moving beyond the range of the A part of the day, that's what I need to know and to figure out what to do. Okay. Now, going back to my PowerPoint here, just keep this here on the side here. That was January 3rd. January 3rd, 2012. A year ago from today. The next day, January 4th, 2012, let's see what happened. Same thing happened. This is the A part of the day. We have 2 consecutive closings outside of the A part of the day. What happened? Market went up. Okay? So it tells me that a trend has now been established based on price, based on it going beyond the noon session. Okay? Now, the next day, January 5th, or actually it's not January 5th, I must have removed that chart, but the next day would have been January 5th. But I happen to have here March 5th, 2012, to show you what happens when the market whipsaws back and forth. Okay? So here is the A part of the day. and here is the B part of the day. It got stuck. We never had proof that it was closing above or below this A part of the day. This is normal. The trending days are not as common, as you all know, right? Markets whipsaw more than they trend. Okay, some questions here. AK says here, do you set the ATR to calculate on bar close? Yes, I do. True. Which key time frame do you look at other than the 5-minute? It depends on what type of trading you want to do, AK. My recommendation is the 5-minute for day trading, but if you want to look at a position trade or swing trade, I'd look at really anything. This is price action across the board, 15-minute, 60-minute, daily. It doesn't really matter. I would be hesitant to go to a 1-minute chart only because the ATR is a lot smaller. You're going for smaller profit. But a 5-minute chart, you're able to get at least a point or more under typical conditions, 4 ticks or more. AK. Javier says here, John, the crude oil, what are the 3 parts for the ABC pattern if I trade in normal Eastern hours? Whatever the crude oil opens at, I believe it opens at 8, if I'm not mistaken, 8 or 8:20. You're still looking at breaking it up into 3 parts. So whatever the crude oil opens at, if it's Eastern Standard Time, I believe it's 8 o'clock. Take the first 2.5 hours, look at the next 2.5 hours. Javier used the same pattern. Owen says here, so you cannot use this until after noon, until after 12. That's correct. The ABC pattern, you have to have a range established in the A part of the day. The A part of the day is where all of the action happens, right? You have the most volatility, you have systems entering, you have traders getting stopped out from day session only methods, you have gaps that occur. So this A part of the day, Owen, initiates a range, and if the market's going to trend up or down from here, I want to have proof of that by the noon B part of the day. And as we go further, I'm going to show you here that the same relationship could occur not just between A and B, but also between B and C. So let me go back here to a few days ago, December 31st. And the same relationship occurs between B right here, up or down, the same relationship is happening. So therefore, if 2 closes occur above the B range, this candle right here, the same thing is true. The market goes up, closes out the day. So I'm using price again for the relationship between B and C and the original A and B. Okay? Just like this, A to B, B to C. A to B, B to C. So I'm looking at this, and I'm looking at what happens in relationship there. Okay? Owen, okay? And now I also mentioned to you that you can look at this in the London Open, right? The Life Exchange opens locally in England at 8 o'clock London time. For me, it's 3 o'clock Eastern Standard, 3 in the morning. Same thing happens, right? If you look at what happens at 3 o'clock in the morning, we don't have that here, but we have it right here. Same exact thing. Here's 3 to 5:30, from 5:30 to 7. I believe 3, 4, 5:30. Right? From 5:30, 6:30, 7 to 8. Same thing. Here is the A part of the day for the London. Here is the B part of the day for the London. So what am I looking at? 2 consecutive closes below, above or below A, or above or below B. Very simple, based off of price, something that I teach, and something that you guys can utilize. Okay. Okay. Don't you find that, Alex says here, that tick charts offer more clarity, like a 2,000 ticks for ES? You know, tick charts do have a place. Now, I do teach a scalping method called the price action scalping method that uses 250 tick charts. It's a counter trend method. I've never experimented or looked at a 2,000 tick chart, so I really can't tell you if that's the way to go, Alex. But I do know that tick charts do offer clarity. I don't know if 2,000 is the magic number, but I do have something that I use for a counter method, which is 250 ticks. Dwayne, John, does the same 85% ratio hold true for the B and to C ranges? Yes, they do, Dwayne. So between the B and C, typically the last part of the day, the last leg of the market journey, it usually stays confined or whipsaws within B. So that also holds true, Dwayne. AK, so what about the Globex open on the E-mini S&P and the Euro cash market close, which overlaps at 11:30, which signifies a global handoff? You have to look at the session that starts it all off, AK. So I'm starting off at the London, and I'm starting off at the US. This, to me, tells me that everything happens here and goes somewhere from this session. Either it whipsaws or it trends. I can't really look at the Globex session because there's not enough activity there for me to calculate anything. Usually it's very slow. I can only look at either the London Open or the US Open. Okay. I'll take a look at it, Alex, the 2,000 tick chart. If it's similar to the 5 minutes and if it gives offers more clarity, why not? Why not use it, right? Mark says here, are you going over the trades for these ABC trades? Well, the trades are as follows. 2 consecutive closes gets you long right here. 14.10, the closing price of the second candle. That's the entry to go long. Mark B. So here's 1, here's 2. That's the entry. Long 14.10. Close of that price. Right there. For the B to C relationship, this is 1, this is 2, Mark. 2 consecutive closes above, 14.50. That's the entry to go long. Close at a second candle. I look down. The ATR tells me what I can expect. I can expect 2.25 points, 2.5 points. 14.50, 14.15.50, 14.16.50, 14.17. There is your 2.5 points right there. Mark. Stops are going to be a little bit different, Mark. The stops that I like to use are based off of, with the ABC pattern, off of some type of proof. So what do I use as proof for the Atlas line? Well, the Atlas line tells me that if there's a closing price on the opposite side of the Atlas line, then it's proof enough to say I shouldn't be there. Well, the same holds true with this ABC pattern. If I have a stop that proves to me that I should no longer be long into this trade, then I'm going to get out of the trade. So the way that this works is that if you enter long here, if there's a closing bar below, I guess the means test, as I like to call it, below 1404.50, a closing price below it, that signifies proof that I should no longer be long, that the trend that I'm looking at is not a trend to the upside, It's maybe whipsawing back down. Whatever the case may be, I shouldn't be long. The same thing here, Mark, with this 14.14.50, 14.14.50. If I'm going long here, a closing price below this means of the high of B, 14.13 quarter, is proof enough that I should no longer be there. Okay, it's based off of proof. Edward here wants to know, can you explain why the ATR is different for tick charts? Well, tick charts are based off of not time. So there's no time. It's based off of the amount of trades that are successful. Okay. So as an example, if you have a tick chart that is very small, the ATR is irrelevant because it's just very small up or down. It's not a true reflection of time, right? If you have a huge range that just ticking back and forth, the market's not going to go anywhere. So you really can't use the ATR with tick charts. The ATR is used with minute charts, in my opinion, as best. And you also can't use the ATR with range charts at all, right? Because it's the same range that's happening with a range bar. So you can't use the ATR with that. Okay, Edward? All right, so to give you an outline here, outline the range from the U.S. session open. For me, it would be 9:30 to 12 Eastern Standard. The B is lunchtime, 12 to 14:30. The last part of the day would be 14:30 to the close, which is roughly an hour and 45 minutes. But now they've extended the trading for an additional hour, so it's a little bit longer. Again, what's normal is price trades within the range of B about 85% of the time. But when it does break out of it, late day rally, late day sell-off, you got something there for you, okay? And I want to catch that late day rally, late day sell-off, okay? I'm going to talk a little bit about the stops, where traders usually place their stops. I'm going to touch on this very lightly. I don't have a lot of time left here, but usually traders place stops at places where everybody else places stops. So if you have a stop at an even number, it's normal that there's also a million other people with stops at that same value. So I don't like to place stops at Fibonacci levels, and I don't even look at Fibonacci levels, but if you do, I would say stay away from that. Or at nice round whole numbers like 1500 or 1450. It's where everybody else puts their stops. I would say let's not do that. High or lows of the day, typical price will bounce off the high or low of the day. Everybody puts their, not everybody obviously, but a lot of traders place their stops here at the high or low of the current trading day. I would say let's not do that, right? Typically markets love double tops, double bottoms, and you're just going to get stopped out while the market bounces off your stop. Okay, support, right? It's basic support and resistance stuff, AK, right? The January effect. Okay, let me talk a little bit about the January effect. And also, you can learn these methods that I'm showing you and more just by downloading or logging in to our newsletter, and you get 3 free videos. It goes into more detail on the ABC pattern, as well as the how to trade the news using the ATR, all those good things I show you for free in those videos. The January effect is something that professional hedge fund, banks, everybody looks at this except for the trading public. So how this works is that in January, the month of January is very important. Now, it's very important because if it's an up month, higher close than open, the market will typically close higher at the end of the year. So in January of 2012, a year ago, I put out a blog post that said basically if January closes higher than it opened, expect the market to rally. And on December, if you're doing options, if you're long term, if you decide to buy the September or December contract way in advance, you are ready. You are going to be well positioned. So I put this blog post out in January 1st or 2nd. I forgot when it was. And then at the end of January, I put another blog post out that said, hey, we closed higher. Buy the market, because we are going to end up with a higher close than open. And a lot of traders did. A lot of traders followed my advice based on this January effect and bought the market and made out very well. So throughout the year, there were a few pullbacks, there were a few markets, few opportunities to re-enter long. And where the market closed at the end of 2012, in comparing it to what happened in the beginning of January, you're going to have a huge opportunity to go up or down. So if the market goes up in January 2013, higher close and open, it's an opportunity to buy the market. You can go back, you can look at it year after year. It only works if it's a higher close than open. Okay, so look at where the market closed in January 18, and this is where it opened January 2nd. It was 1,300 and something. I forgot what it was in January. Actually, I might be able to look at this here and tell you right now where it was in January 3rd, January 4th. 1272, so figure it was about 1,300. You have a huge up move that happened, and if you knew that this was coming based on the January effect, you would have been well prepared to know that this was going to be an up year. So the January effect is based on a higher close and open January. If it happens, you can buy options, you can do a million things. Look to go long at every opportunity for a pullback. Always looking for a higher close every month, just to prove that it's continuing and continuing higher. Okay. One last thing that I'm going to show you is 50% coupon code for the Atlas line, for the power price action, for any of the methods that I teach except for the mentorship. Use this coupon code, NinjaTrader 2013, and you'll be able to get 15% off just for the New Year's special promotion. And if you're interested in joining our January 15th mentorship class, there's also room available. You can email me, you can call me, asking any questions that you may have to see if it's right for you. All right. Anyone have any questions before I hand it over to Ray? Or Wesley, I'm sorry, Wesley. There's Wesley, Ryan, Ray. AK, I don't have a trade room, but I do have training. So every product that I offer comes with live training, and it's recorded for you. So the training is recorded for you as well. AK. Dana, you're very welcome. Feel free to email me. I try to answer the emails in a timely fashion, but I get a ton of email every day. So give me a day or so, I will answer your questions. Through January 15th, Edward, January 15th. Yes, Rick, absolutely. Absolutely, Rick. You got it, Lars. You got it, Alex. Cal. You got it, AK. I appreciate it. Rodrigo, I'll see you soon. And I'll talk to everyone shortly. Thanks, guys. Bye-bye now.